as you've been bullish on bonds over the years, and Sri, that you didn't know any of this stuff was going to happen. It was basically, I think, that you thought there were some structural issues globally in the economy, and that maybe some of the things we did here were Keynesian and wouldn't last. And you didn't know that we were going to have a trade war. You didn't know that inflation was going to stay low necessarily, did you? And you still feel the same way? 1.5 is about where we should be on the 10-year?
To begin with, Joe, you're absolutely right. When I started calling for lower yields, say 2 to 2.5 years ago, I didn't know there was going to be a trade war.
Right.
It was more a case of growth expectations not being met and the 10-year-old very low inflation rates continuing and the Fed not being successful in raising the inflation rate. But the trade war commenced in summer of 2018. And then it became a very important factor to me in terms of why the yields will continue to go down. And this week, in terms of what we are seeing with the trade talks to resume on Thursday in Washington, D.C., I don't have much of much confidence that that's going to yield anything. So in terms of where the 10-year yield should be, Joe, which you referred to, we are right now just over 1.5%. I stick with what I said on my being with you last month, that we are headed toward 1% for the 10-year, and then 175 on the 30-year. 30-year is just over 2% this morning, and we are headed down there as well. So there is still money to be made in so-called risk-free securities.
But you are not, we won't go negative, I think you told us last time.
That's correct. I still stick with it, 1%. And if the things really get to be terrible, I'll even go with a 75 basis points positive for the 10-year yield, but not going anywhere close to zero.
Well, do yields that low support the stock market, or does the growth slowdown that you're talking about undercut the stock market?
That's a great question, Joe. I think 75 basis points or 1% on the 10-year would be very negative for U.S. equities because it subsumes or builds into it a very negative outlook for the economy, and therefore that can't be good for stocks. So you are looking at a safe haven play. You're looking at oil prices going down, equities going down, but gold, U.S. Treasuries, and the German Bund all performing well.